Welcome to the daily update, where I'll go over the action in the market for Wednesday, November 19th, and we'll see how things look for Thursday, November 20th. Okay, well, we had a bit of an up day, but that's not the real big story. The big story is that after the close on Wednesday, NVIDIA came out with their earnings. Last I checked, the stock is up over 5%, so at least the initial reaction to the earnings report is positive, and the futures are positive. This is many hours before the market's getting set to open, but we're up about 1.25%. So now, is this going to change everything back and make it look more positive? We're still negative in the short and intermediate term. We have a negative trend. We gave up a little bit of the negative conviction in the short term, but we're still seeing that overall. And our intermediate term indicators are still leaning more negative, and the market continues to become more defensive. Now, one positive thing that did happen in Wednesday's session is after losing the 50-day moving averages for the semiconductors, those were given back. We recaptured those on Wednesday. We're still below the 50-day moving averages on the major indexes, the S&P, the NASDAQ 100. Those are still negative in the intermediate term because they're below those 50-day moving averages. One thing just to be aware of is, yeah, this could be a launch that could turn things back over positive, and we could start to get back into that positive seasonality that we typically see this time of year. This could also be a pump and dump, where we've seen this before. Also, after NVIDIA came out with their earnings, the market was looking really strong. We gapped higher at the open. We came down to try to fill the gap, but instead of bouncing back up after the gap was filled at the unchanged level, we just kept going down. So we have to just keep both of those in mind. We've got some of the pieces of the puzzle that are coming together now because really the NVIDIA earnings report, that's the major thing this week. Now we're supposed to get some employment data on Thursday, which usually we get it on Friday, and they're still monkeying around with the different economic reports that we missed because of the government shutdown. And we're going to be getting some of that data. We got some of that data on Wednesday, but it's just it's like a buffet of picking out what's this, what's that. It's coming on different days than what we typically have seen it before. Like the employment report usually comes out on Friday. We're going to get some employment data on Thursday. We had initial jobless claims on Tuesday. Those usually come out on Thursday. So it's really kind of mixed up right now. Okay, so before I get into the whole video here, from now until the end of 2025, I have a program and it's free. There's two parts to this program that you have to choose from. One is if you want access to the full-blown program, which has extra videos, and I actually do a trade ideas video based on strategies that I teach in the program. You sign up through Substack. You do have to provide payment information, but nothing is charged to you, so it's free that way. Now, if you just want immediate access to the daily and weekly videos and the newsletter that I put out and so forth, you don't have to provide payment information it's called spxvideos.substack.com. There's a link to both of these below this video, both on YouTube and on Rumble. Feel free to check those out and see if that is useful to you. Okay, so let's go back and talk about what happened. We did have a higher open. Futures were able to eke out a bit of a gain by the time we opened in Wednesday's session, and prices have advanced above R1, 66.65, but we hit resistance at the daily pivot for Tuesday. Now, sometimes that can come back into play before declining back below R1, and we got below the daily pivot for Wednesday at 66.19 and the unchanged level. Then we chopped above and below the daily pivot and unchanged level. The daily pivot and unchanged level were pretty much right at the same level. And then we were able to eke out a gain by the time the market closed. So we were up 0.38%, which is kind of different than what we've been seeing lately. We've been seeing downward closes, and we were still below average with volume. And we are, as I said, negative in the short and intermediate term. Still seeing some weakness, a little bit of improvement in Wednesday's session. Now we're going to have to see. Is this going to switch everything back over to positive, or is this going to be one of those instances where we see a higher open and that's used as an excuse to sell at higher prices before the market gets set to go lower? And you can make a case for either side. Nobody really knows what's going to happen at this point. All right, so some comments. Now, the Bureau of Labor Statistics, they announced that the October employment report, we're not going to get that. So, yeah, that's nice. And then they also confirmed that the September JOLTS report will not be published. So there's some other information that we're not going to be getting. And the Fed's really been fixated on the employment situation, as is the market overall. And these are major reports that now we're not going to receive. And then the October JOLTS job report will be released December 9th. So, again, a little bit of a switch there. The November employment situation report will be published Tuesday, December 16th. Again, we usually get this stuff on Friday. Now it's going to be coming out on a Tuesday. So we're still not only through November, but also into December. We're going to be getting things at different times than what we're used to receiving them. Then another thing that happened in Wednesday's session was the release of the FOMC meeting minutes. Didn't really give us anything new regarding the December rate cut. Some thought that the rate cut would be a good thing to do. Others believe that keeping the target rate unchanged for the rest of the year is likely most appropriate, and nearly all expressed the need to proceed with caution as both sides of the Fed's dual mandate. Now, the Fed is tasked with two main things. Now, a third one's kind of come into the picture with the interest rate situation. But when the Fed was first created back in, was it 1913? That's also when the income tax was created. This was all under Woodrow Wilson, and it was before World War One. Their two main goals were maximum employment, so set monetary policy so that everybody who has a job can have a job. Of course, again, remember this is 1913, maybe 1911. I don't remember the exact year, but this is before World War One, before the Depression, before World War Two. So that hasn't, and we've gone through really difficult times of employment with the unemployment rate being very high, but that's what they're supposed to be doing. And stable prices. Yeah, okay. You can also make a case either for or against that as it applies to the Fed. So this is what they're supposed to be doing. And then they also do this through the manipulation of interest rates so that the Fed is saying, well, let's not do anything that's going to get in the way of what we're supposed to be doing here. And of course, you can agree, disagree with that and say, well, they should be doing this, they should be doing that. Okay. And then mega caps and tech did have a good day. They've been the weaker area now. We'll see if that can kick back into gear in Thursday's session and see the really big stocks which drive the indexes. If they improve tech and semis were able to get back above their 50-day moving averages, as I mentioned there. And we're still below the 50-day moving average with the S&P, but there's this anchored weighted volume moving average, and I'll show you this chart. We're still holding at that level. That's still viable support. Even though we're below the 50-day simple and exponential moving averages, this other form of a moving average is still providing support. All right, and then we're still above 20 with the VIX, 23.66. And when we get above 20, that's when we see the negative annualized returns. We still have this confirmed Hindenburg omen lurking in the background. No new spikes over the last couple of trading sessions, but we do have previous spikes. And so we have to pay attention to this and see if anything develops. And yeah, we're still looking more negative until proven otherwise. We'll see if Thursday is going to make an attempt to change that back and have it look more positive. And then in the short term, our list is a little bit shorter. The Stochk RSI is still on there. The Williams percent R, which was there after Tuesday, it's now off the list. Both CCI charts are still on the list and the stochastics. And then we're getting far away from the 20 period moving average to the downside. The boom indicator, that's off the list. And so we're seeing a little bit of an improvement in the short term. And then we're just kind of waiting to see what's going to happen with this December rate cut. And I have a chart to show you that as far as the probabilities based on what the market's doing. I go over this every weekend in the weekly video as well. Dollar was up, and we're starting to break above that 100 level with the US dollar index. If that continues to go up, and we're in a weekly uptrend, we're still in a negative daily trend, but if the dollar does start to go up, that could pressure stocks because stocks like a weaker dollar. Interest rates, not much of a change here, but they were up slightly to 4.13% with the 10-year yield. Didn't change as far as sentiment, still extreme, which taken by itself, it's like, okay, everybody's full of fear right now on the daily side. We look at our longer term sentiment gauges, we're still looking okay. This is more shorter term, what we're seeing here. But we can then also use this as a contrarian indicator because we're below that 25 level. When everybody's pessimistic and a lot of selling's been going on, pretty soon you run out of sellers. And then the smart money comes in and says, okay, well, prices are probably low enough right now. Let's go in and start buying. And then that's when we see a shift. But we're really not seeing much confirmation of that, at least after Wednesday. A little bit of an improvement. We'll see if the positive scenario is able to continue to develop in Thursday's session. But we're at 11 right now. And we are trending, and it's a negative trend, both in the short and intermediate term. We have the red line above the green line. That's why we're negative, and we're showing a strengthening ADX above its moving average. But both the short and intermediate term trends are not confirmed because they're still below 20. And I still have the bias at negative here. I could have changed that over to positive since it was an up day, but very choppy overall. And I'm still keeping the momentum the last number of days together at negative, and we are trending in both the short and intermediate term. All right, so we did get every week the MBA Mortgage Applications Index for the latest reading, down 5.2%. We break that out with refinances. Applications were down 7%, and purchase applications were down 2%. Then the trade deficit actually came in a little bit less than expected. It was at a minus 59.6 billion. They thought it would come in at 61 billion, and it's also down from the minus 78.2 billion that we saw last time. So here is a chart of the MBA mortgages here, where we saw a little bit of an uptick last week. Well, now it's starting to go back down here. And then the trade balance, where it's getting to be less negative here. You can see over on the left-hand side, where as we go up, there's still negative numbers, but they're just less. And this is a 3-month average. And then the imports and exports, seeing a little bit of a drop off here with both the exports and imports, where the exports are still positive, but the imports are dropping below zero. A lot of that has to be due to the tariffs and different reactions to that. And then the trade deficit here, a little bit less, but again, all these readings here are still below zero as we see more of a deficit and have for decades now. All right, and then looking at this real total return, real again takes inflation into account. If you had put $1,000 into the market here, and what would that have been? It's just kind of interesting to look at this at different times. And then to give it a little bit more context, the green line, this is what the returns would have been here. And this goes all the way back into the 1900s. All right, and then the when it's red, that means we're down. When it's green, that means it's up. And then this is CAPE. This is the Robert Shiller version of the PE ratio, what that reading was at that particular time. And then the long streak above the 50-day moving average is finally over. Okay, how do we perform going forward? Not really gangbuster, but we tend to be up around 70 to 75% of the time. Sometimes we do a little bit better than that further out. But it doesn't necessarily mean the end of the world. It just means, okay, we're going through a pullback right now. And as of right now, the long term is still looking positive. We're not seeing any major shift that way. We are seeing more short-term defensive maneuvering going on in the market, where in the bigger picture, the more offensive or growth-oriented areas are still holding up, but they're taking a bit of a beating lately. All right, and then mega cap growth and tech positioning. This is where still a lot of people want to be, but this also is an area that gets hit hard lately when we've been under pressure, but we're still above the zero level, and we're still above the average here. So still money going in here. All right, and then margin debt gets the S&P 500 and the 6-month percentage change. We are seeing a lot of margin coming into the market, and this is a warning sign when people are using borrowed money to buy stocks. And when it gets to be pretty elevated, that's like a sentiment gauge there because people think, oh, well, the market's going to go up. I'm afraid of missing out here. Well, if I have $10,000, if I buy it on margin, now I can buy $20,000 worth of stock. That when that gets to be too extreme, that causes a warning sign for us to be aware of because when you borrow on margin, you have to pay all of that back. It's not like you're going into business with your broker and saying, okay, well, this fell down in value. We'll just split what's left 50-50. No, whatever you borrow, you have to pay that back in full, which can even eat into your capital even more. All right, and then realized consensus earnings per share. We saw this a couple of days ago. The takeaway that I'm getting from this is we're still looking good here for the S&P. It's going up into 2026 and looking pretty good for the equal weight. Not quite as good here for the NASDAQ 100. But then you get to the mid caps and small caps. It's like, okay, let's be optimistic down the road. And they're very high as far as what they think the earnings growth is going to be for the mid caps and small caps. But we've seen this before, and then it's like every year they take down the really optimistic number, and then they push out the next year on here, and then skyrocket it up. So this is just projections here of what they think is going to happen. And then 6 month rolling change in the S&P 500, the 23% gain over the 6 months in October was the strongest since the COVID recovery. Yeah, it's like, okay, rub it in here. We've been seeing really good rates of return, both 2023, 2024. Now, 2022 was difficult. That was a bear market, and even so far in 2025, it's been pretty good as well. And it's like, well, why aren't we doing that now? We're in positive seasonality, but market's going through a difficult time right now. We'll see, is that going to continue, or are we going to try to finish that up and get things back more on the positive side? And then here, this is a Bloomberg chart, the S&P to end second longest streak above the 50-day moving average. This century, I like it how they say that. Okay, it's 25 years. Okay. And we spent a lot of time above the 50-day moving average, and now we're below it. But we've been able to have any kind of pullbacks. We mainly were dealing with the 20 period moving average for a lot of 2025 after we came up out of the lows in last April, and that the market's been holding up well. Now we're seeing things a little bit more weaker than what we've seen before. And then global equities make strong progress. All right, so here you have the S&P going up here, and then these are just different world global. We take all of this together as a global index, both whether it's Europe, Japan, or the more Asian markets here. All right, then retail sales proxy. This is put out by Edward Ardeni, and the forward revenues of the S&P retail composite rose to another record high this week here. That augurs well for the monthly sales report, which is another report we haven't received in a couple of months. So this going up and to the right, that could be good for the U.S. economy because retail is such a huge part of it. And global loan demand, it seems like the prevailing macro mood, the bigger picture mood right now is one of pessimism. Well, yeah, I'm surprised it's not more pessimistic than it is with all the crazy stuff going on. But here's an interesting data point, according to Callum Thomas from Top Down Charts. Loan demand is on the rise, a bullish signal for growth. So if companies are going in and borrowing money, especially the large companies here and the smaller companies as well, yeah, that means they're going in to borrow money for a reason, hopefully not to just stay afloat. They're using it to build a new factory or research a new product or add to their employment base or something like that. And FedWatch, this is what I go over every week in the weekly video. And we're really dropping down here where it was 95% over in this column that there's going to be a 25 basis point cut. And then it's been dangling around the 50-50 level. Now it's starting to go up to, well, 67% now think that there is not going to be a rate cut in December. Okay, bullish corporate insider activity. Now, we saw about a week ago, I showed a chart that talked about how insiders, these are corporate officers, they're just doing massive waves of selling. But then a couple other charts that we look at show that the insiders are doing buying. And I would be more inclined to trust this chart. This is Sentiment Trader. This is a very good website with very good information. So this, to me, actually stands out a little bit more. Bullish corporate insider activity is typically a favorable sign. Yeah, if you have the officers of a company putting their own money on the line by buying stock in the company that they work for, because they kind of know what's going on there and they would be willing to buy stock, that is considered to be a bullish sign, and it still tends to be pretty high overall. All right, then November. What are we doing here? The ninth. This is the ninth worst first 12 trading days of November on record. Okay, you can't even go to since 1992 or something. Yet, even in the 20th weakest starts, the market has often bounced back to finish the year strong. Yeah, at some point, and I was pointing this out a couple of weeks ago. It's like, do you think that it's capable for the market to have just enough of a decline to throw this positive seasonality, this thing that a lot of people think was just a given? Because after we came up out of the lows last spring, it's like, okay, we deal with the 20-day moving average, buy the dip, boom, we go back up. And well, now people are starting to question that, and they're becoming much more pessimistic about what the market's going to do. And then that's about the time when the market says, okay, yeah, because it wants to leave most people behind. It wants them to have this FOMO, the fear of missing out, because a lot of people, they use their emotions to get into positions. And I found over the years that the positions that are usually the most profitable, they don't feel like the right thing to do at the time. It becomes the right thing to do in hindsight. But if you say, well, I got a pretty good feeling about this, you'll be right just enough to think that you're onto something, that you might have some intuition or insight about how things move. I'm not that good. If When I get into a position that feels right when I get into it, those end up not doing so well. But sometimes they do pretty well. It's the ones that don't feel well, they're typically the ones that do better. And that all deals with emotions and fear and greed and should I, shouldn't I type of a thing. So just because we're seeing some weakness in November, we can't write off the rest of the year. Now, it doesn't necessarily mean that we're automatically going to go up. Things can develop, and there's all these variables being thrown at the market still. But just because we got off to a bad start doesn't mean it's going to necessarily end that way. All right, so here is the intraday chart. Not much of a gap here. We did see a nice little bounce up here right at the open. We had a positive open, got above R1, and then here's the daily pivot for Tuesday, and that's where we topped out, and that set the intraday high. And then we drifted back down below R1, excuse me, R1, and then we actually went negative a little bit, but didn't stay there for didn't stay there for very long, and then we just kind of chopped sideways, went a little bit negative again, bounced up here, and then came down just a little bit going into the close. Yeah, the market's really been waiting for this earnings report to come out from NVIDIA, which is up over, last I checked, it was up over 5% in the overnight session, but we'll have to see where things end up opening there. And we did see a nice little bump because right after the market closes, NVIDIA comes out, they make their announcement, and everybody is happy and things are going up. And so we're not really seeing a big improvement here with our intraday growth and value chart here. We're still going down overall when we look at the intraday chart. But the bigger picture is that this is still positive. And we saw a little bit of an improvement with the intraday growth to value ratio for the S&P, getting back above the moving averages. But since the beginning of November, when we were looking more solid, this really has been coming down overall. So we were up with growth, value was down, kind of the opposite of what we've been seeing lately. Either, well, in Tuesday's session, growth was down, but it was down less than value. Where last week, the big downward day that we saw, value was doing okay, even though it got hit and holding up better than growth. And then for the mid caps, growth was up where value was virtually unchanged, and it was down virtually unchanged with the small cap growth where value ended up being down. So a little bit of a tick back up here with the small cap growth to value ratio. This is still a concern for if in the mid caps, but you can see the index just blah 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 drop lower. That's what we've been seeing most of all over here with mid cap growth to value. This is the one that's a little more concerning because we're below the 50 and 200 day with the S&P growth to value ratio. We did tick up here, but we got a long ways to go to get back to this shorter term positive bias where we're still in an uptrend in the longer term. And a little bit of a tick up, but still in the rainbow with this growth to value ratio. And a little bit of a tick up here with discretionary to staples. We would like to see that doing better. And we're still above the 100-day moving average with the large cap growth ETF, but below the 50-day moving average. And the trend is still negative, and we're starting to get up here. We're not quite above 20 with the short term, but we're above the moving average and going up. The red line is still above the green line, so it's a strengthening negative trend that is not yet confirmed. Same thing here with the intermediate term. Red line above the green line, strengthening ADX, still below 20. Also a strengthening non-confirmed negative trend. And let's see, over here, we were just a little bit below average with volume. And not a real surprise there. Then we look at gamma exposure. Still, the whole chart is red overall. We're at the 6242 level, and it's green because we had an up day here. We do have some overhead resistance at 6650. And if we go down, we have, which we just tested on Tuesday, was the 6600 level as well. You can see the line coming down here. It's intersecting with this blue line. So we have a little bit of overhead resistance, 6650, and some support at 6600, which these are natural support and resistance levels because they're round numbers, and the market tends to shoot to those. And it's still above the moving average here with the Ulcer Index, as fear is a lot higher. We tick down with the VIX, but we're still well above 20, both with the line chart and bar chart. And when we're above 20, according to Tom Balley's research, this is when we see negative annualized returns. So we'll be watching the VIX in Thursday's session if we really keep going up with the indexes to see are we going to get back down below 20 with the VIX. And we saw a little bit of a drop here with the volatility of the VIX. It came down, but still well above the moving average with the bar chart and line chart. And came down, just ticked down slightly with this fear gauge, and we're still going up with this other fear gauge. So not a confirmation there. We want to keep an eye on the spread between risky and not as risky bonds. You can't really see it all that much in this chart. It's the next chart where when this is an inverted version of the chart I just showed you. When this is coming down, that means that fear is coming back into the bond market. The spread between risky and not as risky bonds is starting to widen a little bit here. And so we would like this to go up. Right now, it's been coming down, but it's not really breaking out below what we've seen in the recent past. This kind of puts the VIX and the volatility of bonds together. So the stock market is more nervous than the bond market. Up here, this is your investment grade over 6 months, where we are seeing fear coming back into the market, but it's below average according to this chart, where we're above the 20 level, and the average for the VIX according to this is 19.5. So we are seeing more fear in the stock market than we are in the bond market. And we ticked up here with the daily equity put call ratio. This could have been some hedging going on ahead of NVIDIA's earnings. And even with it being positive, even with the futures being up and the stock price being up, we don't know if that's going to carry through until the close in Thursday's session. So we're still going up with the 5-day chart and the 10-day chart, which is longer term negative when this ratio is still going up and it's showing more conviction. A little bit of an improvement after we've been dropping down when we look at momentum stocks versus the S&P on a ratio basis. And we are picking up here. Now, this has been pretty tame lately, the volatility risk premium. We've been hanging out around the band here. And even with the slight up day that we saw in Wednesday's session, this is starting to go back up. This gave us some clues here back in October and also back over the summer months. And we had that big down day right at the beginning of August. So we want to keep an eye on this. and see if this is confirming the elevated fear that we're seeing with the VIX and some of our other sentiment gauges. So still going down though. So the broader market wasn't all that strong necessarily. We declined with the advanced decline line based on price and volume, even though we had an up day. We're still below zero and declining with the short and intermediate term advanced decline ratio, below zero and declining with the advanced decline oscillator. And now we're rolling over. The 5-day and 10-day charts are going down, and we're seeing a drop off in the new highs, a bit of an expansion of the new lows. And we're negative here. We're starting to drop below the moving average. This is longer term negative when the accumulation distribution comes below the red line. Now, even though we ticked up a little bit here, we're still below the moving average with the boom indicator, and that is shorter term. And we're declining with the Chaikin money flow. That's negative, and we're declining with the Chaikin oscillator. So our three smart money indicators are still negative, even after Wednesday's upward move. And we're still negative with the vortex. The red line is above the green line, even though the red line came down and the green line came up slightly. And we're still below the moving averages with our advanced decline line studies, both with the NYC common stock. We declined here with the S&P. We were flat with the mid caps and then declined a little bit with the small caps. So this hasn't changed. The stocks in the S&P above their 20-period moving averages, below 50 and continuing to decline. In the bigger picture, we've still been seeing these series of lower highs and to a degree lower lows as we've been going down, and that is a negative divergence with what we've been seeing with the S&P itself. But what we're paying most attention to is what's happening right now, below 50 and declining. Also below 50 and declining with the 50-period moving average steady, still seeing lower highs, lower lows. That's negative as the S&P was going up. Trailing off here and seeing a bit of a negative divergence with the 100-day moving average steady. And we came down, but we're still above 50 longer term. So the 200-day moving average steady is still positive, even though the context is that it's weakening. And so we're still below the 50-day moving average on the daily chart here. We're back above this dash line. We broke down below that on Tuesday, where we were able to get back above it on Wednesday. And you can see in the bigger picture here, this series of higher highs and higher lows, that's on the daily side, that's starting to come into question now. We're kind of breaking that pattern as we're seeing this look a little bit more vulnerable, and we were below average with volume. So even with the update, we declined with the 20, 50, and 200-day moving average studies. We ticked up, but we're still extreme negative with the Stochk RSI. We're coming up a little bit, no longer extreme with the Williams percent R, but we did tick up with the CCI 14, but we're still extreme as well as the CCI 20. And we're turning back up because we had an up day. So the short-term stochastic is starting to show some improvement. Now we're starting to look extreme negative and still going down with the intermediate short term. And then the long short-term stochastic is below the moving average and declining below the midpoint. So the shorter term, yeah, okay, a little bit of a bounce there, but the intermediate and longer term stochastics charts are still looking negative. And we bounced up a little bit off the lower band here. That's a Keltner band. When we hit that, that's considered to be extreme. And in the short term, we're still below the three moving averages, and they continue to roll over the 10, 20, and 30. And we're still going down and seeing more vulnerability with the short-term trend based on 20 periods below the blue line and green line and continuing to decline. And we're still below the rainbow with the 10 to 50 period moving averages here. And the longer we stay down here, the more we might see these lines begin to roll over. And this is the anchored weighted moving average. We're still holding out above this. We closed right on it after Wednesday, that was after Tuesday, and then we were able to stay above it here after Wednesday. So this support level, this orange line, is still holding up. Now, if we do break to the downside, we'll be watching this orange level, and then if we break that, we'll be watching this kind of sickly looking yellow greenish mustard color thing here. All right, and we're still in the -2 channel with the standard deviations chart. And we did tick up, but we're still negative with the balance of power, and we're negative with the go no go and flash, and it's flashing a no go, which I guess means stop. And then we're still near the lower end here with the lowest low value chart, still declining with the TTM squeeze, still showing a pickup in speed here with the standard deviations chart. We're above the moving average, And we ticked up, but we're still negative with the ease of movement. Now the Arun finally woke up and said, ah, maybe I better do something. And it's now turned over negative. We dropped down below zero with the oscillator. That means sellers are starting to overtake buyers. As the red line's going up, the green line is coming down. And we're still negative with the S&P McClellan oscillator. We're below zero. So we're still declining with the summation index based on price and volume. Also still below zero with the NYSE McClellan oscillator. So we are declining with the summation index for the NYSE based on price and volume. Still negative with the Switzerland Trading Oscillator based on price and volume. Momentum with the PMO, negative. Negative based on price, negative based on volume. Below 50 and declining with the PMOs that are rising. We're going down with the buy signals, and we're going down with the PMOs that are above zero. So even though we had a slight up day, it was really the mega caps that did that. We're still seeing continual weakness inside of the S&P. And we're still negative with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR. Momentum starting to get a little extreme negative here since we dropped below the red line. But you can see when we were just cratering down last spring, we just went way down here. So I put these lines on here just as kind of guides. There's nothing necessarily sacred about them, but we are negative with the short-term oscillator. We're dropping below the midpoint with the MACD, and we're below the moving average. That's still negative. So in the short, intermediate, and long term, all of our oscillators continue to be negative, as does the Copic curve momentum oscillator. We ticked up a little bit, but we're more in this yellow area here with the Sean trend meter. So the context is that we've been declining. And we're below 50 with the ultimate oscillator. We ticked up, but we're still below 50 with the money flow. We're still above the moving average with unbalanced volume. So this is still hanging in there and looking positive. And we're ticking up with the intermediate and short-term RSI, but they're still both below 50. And we continue to decline. Even though we had a bit of an update, we're just not seeing a lot of strength here with the point and figure charts inside of the S&P. They're starting to produce more and more sell signals. When we drop below 50, that means there's more sell signals than buy signals, and we're continuing to decline here. And we're below 50 and declining with the NYSE bullish percent index, but after coming right down to 30, we are bouncing back up. This is the NASDAQ 100 bullish percent index. And if we do see some more follow through, we might see this start to go back up with even more conviction, but it's still negative overall. Intermediate term trend below both the red line and the blue line and declining, showing more vulnerability to the intermediate term trend because we're below the 50 period simple and exponential moving averages. If we fall here, we'll be watching the 100-day moving averages. So we're below the 20s and 50s. That's why we're negative in the short and intermediate term. Now, I don't base a time frame around the 100. Then I go clear out to the 200 for the long term. All right, and we're still dealing with the high end of the cloud here with the Ichimoku cloud, and we're starting to look a little bit more negative. Now, it's really hard to see. The green line did tick up a little bit. You can see there's kind of a little flip up there. So the short term is improving a little bit, but we're seeing the blue line drop below the red line. That's intermediate turning over the more, crossing over the longer term red line. And we're still at support though, since we're at the top end of the cloud. And also seeing a bit more vulnerability here with the weekly bars. Now, this isn't really being ruined at least yet, but if we end up having more down days in Thursday and Friday session, that might be in question. If we do start to fall, we'll also be watching this R1 pivot point, even though we're still far away from it, a couple hundred points away, roughly. And we're still negative with the Heiken Ashi. Now we're negative since it's red, but we're pointing up with the Kegi chart. So it's negative, but improving. But we're still negative with the Renko chart and the three-line break chart. Longer term, we're falling below the midpoint here with the 150 moving average. We're still above the midpoint with the 200 moving average. And still negative in the short term. I also have us negative in the intermediate term since we're below the 50. And the mid caps are also seeing some weakness currently, and really no changes here. Bonds are still negative in the short term. Commodities are positive across the board, which could end up being inflationary, but I deal with that in the intermarket analysis video over the weekend. And we're still more positive in the short and intermediate term with the US dollar index. So we had tech, that's a growth area, and financial. That's encouraging to see these show some improvement. Discretionary was unchanged on the day. And then energy, a more defensive area, that got hit pretty hard. Utilities, which again, I say this every time, you could go back and forth whether that's a growth area because of AI or it's a defensive area because it's typically been a more stable type of investment. And real estate, so and staples. So these are the more defensive areas, which took a bit of a hit. And then communication, which is a big growth area, that ended up being down as well. And healthcare, we're seeing a bit of a decline. So we saw some negative action right off the bat with utilities having a BPI cross below 80. It had been climbing and climbing and starting to get above 80. Now it's looking like it could be rolling over. Also, we had the BPI cross below 20 with the staples. They've been getting hit pretty hard but kind of holding up for the most part. And then we had the NASDAQ going back up above 22.5, 6, 7, and 8. The dollar index is now above 100. We had a BPI cross back above 30 with communication, even though it ended up being down on the day. The Dow got or fell down below 46,000, and the NASDAQ then ended up getting below 22.4 as we were getting closer into the close. So here's NVIDIA, a little bit of a front run here with with an advance, and we're up over 5% the last time I checked. We'll see how much of that carries through into the open, and if the market builds on that as Thursday unfolds. Apple was up a little bit, Microsoft down over 1%. We had Broadcom up, that was pretty solid there, and Oracle was also up. In the communication, both Google stocks were up, so that helped that area stay together a little bit. So the Dow is still hanging out around this S1 pivot point below its 50-day moving average, negative with the diamonds, with the Elder's Impulse system, and still below the 50-day moving average with the NASDAQ, and trying to hang on to this S1 support level but still negative with the Elder's Impulse system for the diamonds. Same thing here with the NASDAQ, just holding on to this S1 pivot point below the 50-day moving average. Negative with the Elder's Impulse system, NASDAQ 100, still very similar here. Below the 50-day moving average, negative with the Elder's Impulse system. Momentum for the NASDAQ 100 is negative, still below the 50 and below the 20 here with the QQQs. Small caps, they virtually unchanged. They're still hanging out around this S1 pivot point below their 50-day moving average. And we were virtually unchanged with the Russell 2000 small caps, still below its 50-day moving average, still in a longer term uptrend and above the 200-day moving average. And we've gone from negative over to neutral with the small caps, with the Elder's Impulse system, and not really doing much, kind of dangling around this S1 support level with the mid caps, negative with the Elder's Impulse system. The Wilshire still hanging out around below its 50-day moving average, still below the 50-day moving average with the total US stock ETF, and still holding above the 200-day moving average with the financial sector. But again, this is what we've been seeing, the underperformance going back to last spring. And then the ARC FinTech Innovation still holding out above its 200-day moving average, but below the 200-day moving average when we look at the ratio to the S&P. FANG index still below its 50-day moving average. So Apple was up 0.42%, just kind of chopping around quite a bit lately. And we were virtually unchanged, but we're below the 50-day moving average with Amazon. We were down 1.35% with Microsoft, and it's below its 50, but still above its 200-day moving average. And then Google up 3%, setting a new all-time high there. That's positive. And Meta is still just below its 200-day moving average. Ever since they reported earnings, even though the earnings were really good, it's like, well, we're going to spend all this money here for AI, and the stock's been under pressure ever since. Where NVIDIA, we're getting back a little bit above the 200, excuse me, the 50-day moving average. We'll see if it's able to add to that in Thursday's session. And Tesla still below its 50-day moving average, up about 2/3%. And then Netflix, where it had a good day and then it had a bad day, and we're dropping below the 200-day moving average. The Dow Jones Semiconductor, where what I was pointing out after Tuesday, we were below the 50-day moving average. Now we're back above it. The SMH Semiconductor ETF back above its 50-day moving average. And this is the weekly chart. We're still above that 100% level. And again, this is we're just wondering if this is going to feed into more of a downward move with the Dow Jones Semiconductor Index. And again, Bitcoin, I just show it mainly for how it impacts the NASDAQ 100. That's continuing to see a lot of weakness, and we're coming back to some previous lows that were set here because the correlation is high when we look at Bitcoin to the NASDAQ 100, and they're both going down. But as I said, the correlation is high. That means they're moving in the same direction at the same time. And then oil was down. We dropped back below the 60 level there. And we're back above 100 with the US dollar index. And we're starting to come above the 200-day moving average here. But again, on the weekly chart, we're in an uptrend. We still have a ways to go here on the daily side. So not really seeing much of an impact right now with the 10-year based on the yield. That's been behaving okay. And we're still above the 50-day moving average with the 10-year based on price. But our growth to value ratios, a little bit of a tick up, but still looking pretty negative across the board with the Qs to S&P, discretionary to S&P, and large cap growth to value. So large caps, mid caps, and small caps, all three of these are still below their moving averages. And then we don't have a new spike here, but we do have a series of spikes with the Hindenburg Omen. And we just want to pay attention to that because we saw this before the COVID crash, right at the end of 2021. Now we're waiting to see, are we going to see a similar thing happen here with this latest signal and series of spikes that we've been seeing? All right, so NVIDIA earnings came out and we're up over 5% once they reported their earnings there. So that we're at least we're seeing some positive action that way. And we're still negative in the short and intermediate term, but positive in the long term. Now, and I added this here. It's like, okay, we're supposed to get the in September employment report. I usually don't include the names of the month. I'm just like, okay, we're getting the next employment report that we're supposed to get. But because we had a couple of months there that we missed, we kind of have to use the month name to see what we're getting. And there's probably some other things that are going to be coming out, but the calendar's still really messed up. And then anything geopolitical that may happen here. But again, the market's more worried about these employment reports and fixating on NVIDIA's earnings. And I haven't been updating this lately either. Now, seasonally, for the Dow, we're neutral to negative for November 20th, where we're neutral to positive with the S&P and NASDAQ. So not much of a real edge here. And we are also dealing with options expiration week. Friday will be the last day before options get set to expire because they actually expire on Saturday, but the last trading day is Friday. And then here we see a little bit of negative seasonality during a post-election year. Pretty much all the indexes see a bit of a dip before we see a couple of good days after that, often from a seasonal basis. And again, just going through this, the first half, nope, wasn't good this year, but it typically is good for November. We'll see if the second half can redeem itself a little bit. This also shows some positive seasonality. And then after the Fed comes in and cuts rates, we typically will see some positive seasonality from that. This also shows positive seasonality, positive seasonality, positive seasonality here. So we've totally gone against that in the first half of November. We'll see if things continue to look weaker or if the market is able to turn back more positive. All right, so we're still negative with our three smart money indicators, and we're negative in the shorter term with the growth of value and discretionary to staples. And we're still negative with the swirling trading oscillator, the parabolic SCR, the money flow, and the ultimate oscillator. The momentum oscillators are negative, and the McClellan oscillator and summation indexes are negative, both for the S&P and NYSE. Ease of movement is negative, and the bullish percent indexes continue to be negative, mainly for the S&P, but they're also below 50 and declining. Well, we bounced up a little bit with the NASDAQ 100, but still declining with the NYSE. And the vortex is negative, as is the momentum for the NASDAQ 100. And we've got this Hindenburg omen lingering in the background. Okay, positive side, still longer term, we are in uptrends with the growth of value and discretionary to staples ratios. The financial sector is still in an uptrend, but it's been underperforming the S&P since last spring. And then the long-term special K chart continues to be positive, and that's very long term. And then just want to show these are the daily pivots that are posted on the YouTube community tab. and we're holding out above this support level, at least for right now. And then here are the pivot points for Thursday's session. We'll see how things play out that way. So our conclusion didn't change anything here because nothing really has changed. We are negative in the short and intermediate term. We're still seeing more negative momentum. Now it improved a bit in Wednesday's session. So we'll see if there's more follow through with that. And we're seeing a trend in both the short and intermediate term. But we're still negative overall, and we're still long term positive since we're well above the 200-day simple moving average. Thank you. Have a really good day, and I will talk to you in the next video.